Understanding Level 1 Assets in Financial Markets. In the landscape of finance, the classification of assets plays a critical role in risk management, investment analysis, and regulatory compliance. Among these classes, Level 1 assets stand out as the most liquid and transparent. This article delves into what Level 1 assets are, their characteristics, the importance of their classification, and their advantages. What are Level 1 assets? Level 1 assets refer to a category of financial instruments that possess readily observable market prices. They typically include listed stocks, shares of publicly traded companies that have a stable market presence. Bonds, government and corporate bonds that are actively traded on exchanges. Funds, mutual funds or exchange-traded funds, ETFs, that have a consistent market valuation mechanism. These assets derive their fair market value from a consistent mark-to-market mechanism, enabling investors to ascertain their worth based on current market conditions. The transparency in pricing allows for confident valuations, making Level 1 assets easy to trade and liquid. The classification hierarchy, Level 1, Level 2, and Level 3. The Financial Accounting Standards Board, FASB, Statement 157 introduced a three-tier hierarchy for classifying assets based on the reliability of their fair market value ascertainment. Here's a breakdown. Level 1, assets with quoted prices in active markets for identical assets. For example, publicly traded stocks fall into this category due to their high liquidity and availability of market data. Level 2, assets where pricing is based on observable market data for similar, but not identical, assets. Examples include corporate bonds that do not trade frequently. Level 3, assets lacking observable market inputs, valuations are often based on internal models or estimates. These may include private equity investments where there's limited market activity. The introduction of this classification was spurred by the financial crisis of 2007, as it became apparent that many investments were difficult to value in stressed markets. Importance of Level 1 assets. Level 1 assets serve as a benchmark for assessing the strength and quality of a company's balance sheet. The presence of a high proportion of Level 1 assets can signal stability to regulators, investors, and analysts. Here's why they are crucial. 1. Market liquidity. Level 1 assets experience regular pricing, which allows for quick sales without significantly impacting pricing. 2. Risk assessment. Investors and creditors are more comfortable with entities that hold primarily Level 1 assets, as these are less prone to sudden valuation drops. 3. Valuation reliability. Because of their observable pricing, Level 1 assets provide a clear and dependable basis for financial reporting. During market turbulence, the importance of Level 1 assets becomes even more pronounced. While investors may trust the valuations of Level 1 assets, difficulties can arise for assets classified as Level 2 or Level 3. Without observable market data, investors may have to rely on subjective models, leading to skepticism about the reported valuations. Advantages of Level 1 assets. The advantages of Level 1 assets extend beyond just market liquidity. Transparent pricing. The presence of transparent pricing instills confidence in financial statements and analyses. Regulatory compliance. Companies with significant Level 1 asset holdings are likely to encounter fewer regulatory hurdles, as the risk of manipulation or erroneous valuations is lower. Investor attraction. Investment firms often prefer portfolios rich in Level 1 assets as they tend to outperform holdings with illiquid assets in volatile conditions. Market resilience. During periods of financial strain, Level 1 assets generally maintain their value better than their Level 2 and Level 3 counterparts. This resilience further reinforces their attractiveness to investors. Conclusion. In conclusion, Level 1 assets are fundamental to understanding financial markets because they provide a clear depiction of value and liquidity. Their classification underlines the importance of transparency and reliability in asset valuation, especially during periods of market stress. As investing evolves, the significance of Level 1 assets will likely continue to grow, shaping investment strategies and financial reporting standards globally. Overall, maintaining a diverse portfolio with a strong emphasis on Level 1 assets can offer investors a prudent path to navigate the complexities of financial markets.